Davis is head of fixed income and money markets for BMO Global Asset Management, and we are pleased to have him here to help assess the jobs picture. Nice to see you.
Good morning. Pleasure to be here.
Overall takeaway from the latest jobs numbers?
Neutral, but it does confirm our anticipation of eases starting in Q3, not before that. And I could speak to that in a bit.
Yeah, so people will see a headline, they'll see job creation, they'll see unemployment rate going down, which immediately makes you think, oh, okay, maybe there's enough resilience out there that the Bank of Canada can hold the line. So maybe partially true and partially the reason why you would say there's no need to cut rates tomorrow, per se?
Yeah, it's so definitely partially true. How I would categorize it, if you want to prioritize the different elements of the unemployment number, that's probably number 4 or 5. So number 1 would be wage inflation. It did come down from 5.7 to 5.3, but still way above the level of the Bank of Canada feel comfortable with, which, I would say is 3 to 3.5. So we still have some work to do there. The other one is the actual unemployment rate number. That puts together, immigration versus job creation. What I think the trigger number there is for the Bank of Canada to advance their easing cycle is 6%. This one was supposed to go up to uptick, but it downticked, right?
Yeah.
For the underlying reasons that you said that aren't as strong. There's a lot of part-time jobs, less full-time. There's a lot of government jobs or public jobs, less private. Those things point to a deteriorating trend, but those are third tier, fourth tier sort of data points on this one.
Okay, so right now the unemployment rate is a little below 6%. Once you get to 6% and beyond, that becomes quite a red flag, in your opinion, for the Bank of Canada. And then if you start to see a real deterioration in some of that wage growth,
yes,
which is cooling, but not as much as you would say that would sort of send that red flag right now, those are some key watch points this year.
Yeah, and they're both parts of the equation of how many dollars are in people's pockets to spend in stores and restaurants. So the unemployment rate's reflective of how many people in the population are working. That's a check they're getting every 2 weeks. And then the average wages says how much they're making. So you put those two things together, people are making more after inflation, because inflation's around 3.5 and 4, and depending on what you look at. So that is more demand in the economy. This speaks to why that resilience in the U.S. economy is now being seen in Canada.
Now, here's the tricky part, it would seem, because there doesn't seem to be a debate out there that we've seen interest rates peak. Actually, the Bank of Canada sent that message fairly clearly. The question is, how long do rates stay at current levels? If there is some kind of pivot, when does it happen? And to what extent do we see rate cuts? So there's a few different pieces there. And I guess some who are concerned about the state of the economy would say, why do we have to wait until we see, those unemployment rate hurdles, a real deterioration in wage growth to actually start getting on that rate cut train? What's the balancing act there?
So the balancing act is, what is the central bank's focus? If the central bank's focus is growth, then they ease earlier. If the central bank's focus is inflation, they ease later. We're on the side that they're focused on inflation. The market's on the side that they're focused on growth. And the reason why they will wait, they don't want to risk getting inflation even higher than it was previously if they make the market too stimulative too early.
And is that just good old-fashioned mandate focus, or is it that they feel like, I'm not talking about the Bank of Canada, but all central bankers feel like they got a little bit of egg on their face for being late to the inflation fight?
Yeah, I'll put it this way. It's good old-fashioned 1970s mandate focus, with the temptation to come back into the 2000s focus, which is the growth focus.
Okay, so the reason we're obsessing over the rate story, to your point, aside the fact that, some people are really struggling with higher borrowing costs as well, but the market itself has been pricing this potential reality into the markets, and all the markets, fixed income market, stock market. So you think that there will be a change in policy for the Bank of Canada this year, that they will cut rates, but it won't happen before the third quarter? Can you sort of expand on that a little bit?
Yeah, I'll definitely expand. We think there's a 75% probability they start cutting rates in Q3, September.
Okay.
There's a 20% chance that they do nothing for all of 2024, and there's a 5% chance that they actually hike rates this year. We're still not out of the woods on that.
And a resilient economy, but more specifically, just frustrations on the inflation fight would be considerations on keeping rates where they are? Or?
It's all inflation, specifically wage inflation and services inflation. That's where we're seeing the stickiness of inflation. So to break it down further, those are the two things that we're looking at.
And then just to match that with the market expectations, what is the market expecting right now on rate cuts this year?
Yeah, they're still expecting a probability of a start before June. It's 100% by the summer, June. But this is what makes active management. We have a different view from the markets, which allows us to monetize that, and that's what we're doing.
Okay, so as an investor, how are you thinking about this?
Yeah, as an investor, it is from a credit and corporate credit perspective, corporations are still going to do well. Maybe not as well as they did last year, but they're still going to do well. So you're good looking at holding corporate bonds. Maximize the yield you're going to get with good quality and high quality names. That's one of the things from an investor perspective. And from a duration perspective, I say that's why I say put it in the hands of an active manager. We want to be long duration, so we want to buy longer dated bonds, just not yet. We think we'll get a better opportunity to do so, to get a higher yield on a 10-year bond or 30-year bond. And that's important as well.
So just to explain that to our audience, the yields that are on these bonds are impacted by rate policy and market expectations around rate policy. So if it takes a little longer for the rate cut cycle to begin, in theory, we may not have seen a peak in those yields, and you want to grab the best yield you can before you literally push the buy button?
Yeah, I smile because I can't do a better job of explaining it, but that's exactly it. So it's not quite time to really load up on buying bonds because there's a chance that the market will go higher in yields. That's when you load up on buying bonds.
The only question I didn't ask you here, you have to do a lot of prediction analysis in your job. Where do you think the economy lands through all of this?
You know what? I think the economy in 2024 is going to do very well. It's going to surprise to the upside. We have to evaluate again in December for the future year because we are coming closer to the end of the business cycle. Right now, it looks good, the landing path, but we'll reevaluate that in December.
Okay, Earl.